Okay, hi everyone. This is going to be the problems video for chapter 8. We're going to do two videos here. This last guy right here is a big guy, so I want to do a separate video for that. So let's look at these, right? We'll start here with brief exercise 8.1, right? They want to know here what amount of ending inventory should be reported on the balance sheet. Then they give us some facts, right? A company began its fiscal year with 186, right? So beginning with 186. Purchases and cost of goods sold for the year were 945 and 982 respectively. So purchases were 945, cost of goods sold were 982. How do we deal with this, right? So we know our inventory T account, right? Essentially, it's going to be our beginning inventory, right, of 186. Then we're going to do our purchases, right, of 945. We'll back out, right, our cost of goods sold, right? So in this case, that would be 982, right? And then that will get us our ending, right? So if we were to just sum these guys, right, there we go. Our ending inventory is 149. So really think about it. What did you start with? What did you buy? Right, well, I started with 186. I bought 945. Hey, I sold 982. So that means the leftovers got to be 149. Right, it's just taking that T account, plugging the numbers in there. Okay, so kind of cross that off. We did that one. All right, 8.2 says a company uses a perpetual inventory system. So we know this is like a live time. Every time there's an incident with inventory, we got to account for it. So they say we had began the fiscal year with 267. We purchased inventory of 845. We sold inventory of 902 on account for 1,420,000, right? So we bought it for that. We sold it for that. Can you please prepare the journal entries? Okay, so we're looking at brief exercise 8.2 here. Sorry, I'm mixing this up. Brief exercise 8.2. Okay, so we have various things to deal with this. So we know we bought some inventory, right? That was the first thing they tell us. We began the year with it. And we purchased inventory for 845. Right, so we're going to do debit inventory for 845. We're going to do credit account payable for 845. Okay. Then, right, it said that we sold some inventory, right? So here, when it's a perpetual inventory system, we will have two journal entries, right? The first is we got to record the revenue, right? So we're going to do debit account receivable for the selling price, right? In this case, 1420. And then we're going to do credit revenue for 1420, right? That's great. That's journal entry 1. And then, hey, we've sold it. This is perpetual live time. We got to do the cost of goods sold. Take the expense and get the inventory off the books, right? So debit cost of goods sold, credit inventory. It looks like we paid 902 for that inventory. So that was the cost of the goods we sold, right? 902. We paid 902 for it. All right. So that was brief exercise 8.2. Now, piece of cake, nothing too hard there. Then they say, oh, okay, can you please do the same thing except for a periodic system for brief exercise 8.3. Okay, so brief exercise 8.3, right? So we bought the inventory. The thing here is whenever you're using a periodic system, right? So I'm going to put over here perpetual. Right, and over here we're using periodic. Couple things to be aware of, right? So we're going to have a lot of temporary accounts throughout the period, right? In other words, we're not going to really touch inventory until the end. And then likewise, we're not going to take cost of goods sold until the end of the period, right? So if we're literally just working on these facts when we bought it, we're going to do debit purchases, right? That's going to be a temporary account we get rid of later for 845. Credit account payable, 845. Then we sold the inventory. Here, we're going to have to account for the revenue, right? We'll do journal entry 1, right? Credit revenue, 1420. We're not going to do journal entry 2 right now, at least, right? We're not going to do it the day of. We're going to wait until later to do it at the end of the period, okay? So that's the idea with these two. So brief exercise 8.1, 8.2, 8.3, there we go. All right, let's move on to the next tab here. We got 8.4 and 8.5. All right, so 8.4, let's do it over here. They're giving us some info, right? We have K Corporation, shipped goods, FOB destination on December 29th. The goods arrived in January. Okay, so their destination, they didn't arrive until January. In addition, right, one of their major suppliers shipped goods to them, right? So we have a supplier who's shipping goods to the K company, FOB shipping point on December 30th. It looks like that arrived in January. They want to know, hey, what shipments should be included on the December 31st inventory of this, K company, right? So we got two things going on here, right? On 12/29, right, we have, K company, right? They ship, right, some goods to a customer, right? So in this case, they are the seller, right? And the terms of that are going to be FOB destination, right? And they don't arrive, that guy doesn't get it until sometime in January. On the flip side, right, in this case, we're the seller. On the flip side, right, we have a supplier ship to K company, right? Now we're the buyer some goods on 12/30. These goods don't arrive until January. And this is FOB shipping point. Okay, so FOB destination, FOB shipping point, we're the seller, we're the buyer. What is in our inventory, right? What are we going to include here? Well, we got to think about this, right? Well, we have over here FOB destination, right? We shipped it on 12/29. It didn't get there until January. Accordingly, right, if we're at 12/31, because it hasn't reached the new person, it hasn't satisfied FOB destination. Therefore, legal title hasn't transferred. Because legal title hasn't transferred, it's still ours, right? So this guy over here, right, that inventory is still going to be ours on the 12/31 financial statement. Over here, right, if we look at this guy, right, let's think about this, right? In this case, it is FOB shipping point, right? They're shipping it to us, right, on 12/30. Okay, and then what happens is, right, as soon as they ship it, right, it's not their responsibility anymore. It becomes ours, right? So here, that's also our inventory. So you have to analyze it, right? When you look at it, are we selling something? Are we buying something? Is it FOB shipping point? Is it FOB destination? Are these conditions satisfied? That will tell us whether it's our inventory or the other guy's inventory. All right, so exercise 8.5, right? Dino Land shipped consignment inventory of $200,000 to storing company on December 1st. Okay, so we're going to have Dino with a D, right? And they give $200,000 of inventory. Let's just, instead of calling it a storage, right, we'll call it a pawn shop, right? Because that's easier to think of. This is a consignment case. It looks like the pawn shop agrees to sell the inventory, right? They're going to take a 10% sales commission. During this time, right, Dino Land's going to maintain title and control. And it says, hey, by the end of the year, the pawn shop had sold $60,000 of the inventory. They sold that for 90 grand. All right, the question here becomes, in light of these facts, how much inventory, if any, should Dino Land include in its ending inventory? All right, so we know the rule here is when you have this consignment arrangement, in other words, we're the consignor, we basically give these goods physical possession to the consignee. Unless and until the pawn shop sells those are our goods. In this case, right, we gave 200,000, right, the cost of that inventory. They sold 60,000 per the facts, which means, right, if they sold 60, there must be 140 they have left, right, they kept. Well, that 140 they kept is going to be Dino Land's ending inventory, right? Even though the pawn shop has physical possession, we, Dino Land, whatever the hell Dino Land is, have legal title to it. So that's our inventory. We got to put it on our balance sheet. All right, let's look at this one here, right? We have the Churchill Corporation uses a periodic inventory system and they use LIFO. Okay, beginning inventory consisted of 20,000 units listed in chronological order, right? So we have, in this case, 20,000 we began with that was comprised of the following: 12 and 8 at 8 and 9, right? There we go. You can see the total cost with it. They say here, right, per the facts, that during 2024, right, inventory quantity declined by 10,000 units, right? So what this really is saying is during the period, right, what we sold is going to exceed what we purchased. And when you did that, right, it would be basically, right, negative 10,000 units. Right, that was how much it exceeded it. And what's happening here is this 10,000, right, how much it overall declined, we're going to have to dip into these previous layers, right, when we have LIFO, because it's last in, first out, right? We have 10,000 to account for, right? We're going to draw from these piles, work from the bottom up, right? So we have 10,000 to account for. We're going to say, hey, 8,000 of that last in, the newest stuff relatively here, we will draw from that pile, right, from units. And then, right, so that's great. That, you know, kind of kills that second layer there. Then we're going to have to dip into that, you know, original layer, right, because we got 2,000 left. Right, so we'll have 8,000 units at, let's see here, you know, the cost with it, you know, so at $9 and 2,000 units at $8, right? That's the starting point. Let's start with units. What they're asking us here, right? Because they're giving us some information and then they tell that. Then they say, can you please calculate the before tax LIFO liquidation profit or loss the company would report in a disclosure note? So first off, why is this a LIFO liquidation? That's basically saying, hey, we had to, in order to satisfy LIFO, dip into the previous layers. And when we do that, right, one of the things that happens is there's going to be a mismatch, right, because we bought some stuff during the period at $12. But when we dip into the prior layers, right, those costs are going to be lower, like $8 or $9. So, some of our profit here from this, in this scenario, this setup is going to come from the mismatch. And the mismatch basically says, hey, what it currently is selling for, what we sold it for, we can sort of use this, what we paid for it proxy, coming from and compared to what those historical kind of original layers were, right? So the mismatch. So what they're saying here is, can you please tell us how much basically profit, before tax profit, came from or derived from this mismatch, right? So we know the units. Now we got to think of the mismatch, right? So we're going to then do multiply that times, right? We're essentially saying, hey, the current price or what we paid was 12, but up here from the 8,000 units, those only cost us $9, right? So there is a, like a $3 mismatch there. Right here, right, we're going to use that 12 again. And from that pile, right, it cost us $8. So there's like a $4 mismatch. Right, so when you do the math on that, right, like 8,000 times 3, right, that's going to give you 24,000. 2,000 times 4, right, that's 8,000. Right, essentially what you're looking at here is 32,000 of before tax LIFO liquidation profit, right? That's really what it's saying, right? This profit right here was caused by dipping into the previous layers, right? It's exposure by virtue of this mismatch, right? So the answer key here, what does it say, right? When inventory quantity declines during a reporting period, right, which happened here, negative $10,000, liquidation of LIFO inventory layers carried at different costs, i.e. those ones we saw above, that's going to create non-current costs being matched with current selling prices, i.e. the mismatch. Then it says, if the resulting effect on the income is material, it has to be disclosed, right? So that's saying, hey, would you do a footnote for this on there, right? So they're saying, what would you report here in the disclosure note, the call of the question? And then it says, in this case, the effect of the LIFO layer liquidation is to decrease the cost of goods sold and thereby increase the income before taxes by $32,000. Another way of just saying, hey, the mismatch generated $32,000 of before tax profit. All right, let's kind of move on here to the next item on here. So they're giving us some information. All right, we got a Cars Electronics adopted dollar value LIFO on January 1st when the inventory value of one of its inventory's pools was $720,000. The company decided to use the CPI to adjust for changes in cost level. On January 1st, 2024, 1 year later, right, so like a whole year later, the CPI was 240. Or I'm sorry, on January 1st, 2024, the beginning of the year, it was 240. On December 31st, 1 year later, ending inventory was 880 and CPI was 264. That's a mouthful, right? There's a lot going on here? The first thing we got to do is, right, they're giving us kind of this CPI number, right? We're going to use this to help figure out, hey, what was caused and what is due to inflation? So they're kind of giving us an original CPI at the beginning of the year of January 1st, and then they're giving us a CPI at the end of the year, December 31st. And let me change those colors. Maybe I'll make it blue and yellow. Okay, so what we got to do is, because they're kind of giving us the gross number here, we got to get this and do a little bit of math, right? So we're going to take, right, the basically the 264 right here over the 240, right? That's going to give us 1.10, right? That's going to be the cost index in essentially what we call the layer year, right? The first year of the layer. Up front, right, the starting year, the base year, it's going to be equal to 1.0, right? So it's for like the base year, it's 1.0, right? Like $1 today is $1 a day. And then sort of, the layer one, there is only one layer here. There's not multiple layers. It's 1.10. Okay, so the starting point is we got to take these sort of gross numbers and put it in and do a little bit of math here. All right. Then what we do, right? We can create a little formula down here. So we'll have 1124. Okay, that's the starting point, and we will have essentially here our ending inventory. And let's just put it in this case, right, well, in the gross amount. So let's go in here, we look at this. Our beginning inventory, right, is going to be $720,000. Last year's ending is this year's beginning. That's why we could put it in that column. And then at the end of the year, 12/31/2024, they tell us that it was, let's see here, 880. Okay. So it looks like, right, it's gone up, the inventory. The problem is some of that, yes, it has gone up, but some of that may be due to inflation, right? We don't have more stuff. We just, have, more price, more money we paid for it. So we need to kind of do a little bit of math here to like back into that and figure out what's going on. So we'll have that ending inventory, the gross amount, what they give us. Then we're going to use the CPI for the base year and the layer year, right? Because this is considered a layer in the sense that it's like we had our beginning and then we had some more stuff. Right, so it will be 1.0 and 1.1, right? We're going to divide that, right? And that will give us our ending inventory basically in the base year price, right? To kind of be able to compare these. So if we do 720 divided by 1, right? Well, that makes sense. It's going to be 720. If we do 880 divided by 1.1, it's going to be 800,000, right? We're trying to get apples to apples comparison here. Okay. One of the things, right, you can see is when we look at it, oh, it's gone up. Once we get that inflation out, right, really 80,000, it's gone up of like stuff, right? Like so I'm just going to put stuff, i.e. not inflation related. It's just more inventory we have, okay? Next, what we're gonna do is, right, we're going to have the ending inventory and base year. All right, so let me copy these two down. All right, so we'll just carry these numbers down. I don't know why that's not copying. do an equal sign, that's good enough. And what we're next gonna do, and let me space this because right, the next thing we'll have down here is the layer. Right, so 720 is 720, right? That's what we started with in there. Then we'll have our CPI, right, for year one of 1. Right here, we're going to multiply it. Right, and that will get us our inventory, our ending inventory and dollar value LIFO, DVL, dollar value LIFO. Right, so it's, it's $720,000, right? Now, right, if you think about it, right, we have, right, down here, in 12/31 year, like at the end of the year, right, we have to account for this. So we will do, right, let me get this out of the road here. Right, so let's start kind of fresh down here. We're going to start with what we had, right, 720, right? And we can, when we do this, then think about, all right, that's what we started with, but we added $80,000 of more stuff, right? That's how much it grew, right? So in this way, right, we now have the 800,000, right? That's where we got it. So you could just put 800 here if you wanted, but I wanted to show you that breakout. But we got to continue with that breakout in the sense that 270 of it, or I'm sorry, 720,000 of it is from the base year. 80,000 is more stuff, right? We're going to then, right, you got to keep the base year at the base year CPI, the layer for year 2, the more stuff at 1.10. We're going to multiply here, right, each one. So multiply, multiply. Right, 88,000. We sum these two guys together. That is going to be our ending inventory under dollar value LIFO. Right, so again, what did we do here? This one's a little bit tricky, it's a little bit new. First thing we had to do is figure out the CPI, right? Do the little equation. For the first layer, it's 1.10. We use that down here whenever we deal with the first layer. Originally, kind of the underlying, the base amount, a dollar a day is a dollar a day. We can use 1.0. All right, so what we do is we take the ending inventory, what they give us, 720 and 880. We divide by the CPI for the respective years, right? That gets us 720,000, 800,000, apples to apples comparison. Once we get it apples to apples, we see we went up, we got $80,000 of more stuff in that way, right? Compared to like what was the cause of inflation. So then what we do is we have to run this little schedule, right? The beginning is what we started with. You basically can use that. Then, right, our ending inventory in base year is 800,000, right? You carry that down. We broke that out between what you started with and how much more stuff you got, right? You multiply that over times the base year CPI, you multiply that times the layer year CPI, add them together, right? That's our inventory and dollar value LIFO. All right, here, let's kind of see, do we want to do that one? No, we'll skip this one just because we're pushing up against time here. Let's look at problem 8.1. So they're giving us some information, right? Let's see what's going on here. All right, we got Autumn Company. They began the month of October with inventory of 15,000. So that's our beginning inventory, 15,000. During the month, they engaged in some transactions, right? So it looks like they purchased some inventory on account for 22 grand, 210 net 30. They used the net method to record for that. And the terms were FOB shipping point with freight charges. So we bought some inventory, there was a discount, and we paid some shipping. October 31st, we paid for the inventory. So we must have done this on account. Later on, we paid off that account. And then, hey, during October, inventory costing 18 was sold for 28. So we sold some inventory. And then they say, hey, at the end of the period, we did a physical count. We got 19,000 of inventory on hand. Two things here. They want us to account for the journal entries if it's perpetual, and they want us to account for the journal entries if it's periodic. Okay, so let me start with, which one do we want to do here? Okay, the first one is perpetual. So let's start with that. So the beginning point here is, right, we bought some inventory, right? We bought inventory. What would be the journal entry here, right? So it looks like we use the net method in this case, right? So we're going to do debit inventory. This is perpetual, so it'll be inventory. You'll see with periodic, it's purchases. We'll do credit account payable. For how much, right? Well, they say we use the net method. So it's going to be the 22,000, right? The price times 0.98. In other words, we have like a 2% coupon pretty much. Well, if you have a 2% coupon, you're only going to pay 98% of the price, right? That'll give us 21.56, right? We assume up front, hey, we're going to do that. On top of that, right, we pay some shipping, right? We said basically all of the costs up until we sort of flip the on switch or we hang the t-shirt in the store, all of those are going to become capitalized or part of inventory, right? So for the shipping, we're going to have to do debit inventory, the freight in, $500, credit cash, $500, okay? All right, then they say we paid off this account payable, right? And we got to look here to see, was it in the window? All right, 210 net 30, October 12th, October 31st. Okay, that's outside the window, right? We missed the bus on this, right? 10 days from October 12th, October 30th, like, this is like, you know, trying to do turn in homework from week 2 at the end of the semester, right? That ain't gonna fly. So we missed the bus on this. We're outside the window, but we do pay off this account payable. So how do we deal with this, right? So we're gonna have to get the account payable off the book, right? Debit account payable, right? It's on there for 21.56. We got to get it off for that. Because we missed the bus, right, we got to pay it back at the gross price, right? Credit cash for 22,000, the whole shooting match. The difference here, right, is going to be the discount lost, right? In other words, what we thought we were going to get, but we actually didn't get, right? 440, which essentially would be like 2%. You know, of the amount there, okay? Then we have a sale, right? We sold some inventory. they're telling us, right? Looks like it cost 18 and we sold it for 28 and it was on account. So there's two journal entries here, right? When we sell in a, the perpetual system, one is we got to record the revenue, debit account receivable, credit revenue for the sales price of 28,000. Then we got to hit the cost of goods sold and get the inventory off the books, right? Debit cost of goods sold, credit inventory, right? At cost, the cost of the goods we sold, not what we sold it for, it's the cost of the goods sold. They told us it was 18,000. So you can see every time there's a transaction, hey, we're going to do a journal entry for it, and we're going to hit inventory, inventory, inventory. Likewise, when we sell it, at that point in time, we do the journal entry for cost of goods sold under perpetual. Now let's do periodic. Trying to be artistic here. I should just kind of do the journal entries, right? So we got to do, we buy it, right? And again, so we're using periodic. We're using the net method. We think we're getting the discount here. And, we know with periodic, right, the difference is we're not going to use inventory. We're going to have a lot of temporary accounts that we tee up and then we get rid of them. So here when you buy it, right, you're going to do debit purchases, credit account payable for the 2156, right? Still the same amount. We still think we're getting, the discount on this. Likewise, right, we're not going to, hit inventory here. We're going to set up a freight in account, another temporary account, and we're going to do credit cash for the 500, right? So the temporary, right, we're going to have these sort of temporary accounts we tee up. We're not hitting inventory. Then we pay, right? We pay off. This case, right, we're not in the window. Now, one of the things here, right, if we read the facts, it says when you're doing the second thing, periodic, it says they consider the purchase discount lost as part of interest expense. Okay, so for this item here, right, we're going to treat it as interest expense. We're not going to do purchase discount lost. So what we'll do is debit account payable, debit interest expense. Why? Because they tell us here, hey, when you're doing periodic, treat this as interest expense. And then we'll do credit cash, right? So that will be just for these guys right over here, okay? If we did do debit discount lost, right, that would be a temporary account that we would get rid of at the end, but they're just saying, hey, treat it as interest expense. Then we have the sale, right? So for the sale, right, we got to do journal entry 1 to record the revenue, right? That's great, but, right, we're like right here whenever we sell it. Where are we selling it, right? October, during October. We don't take cost of goods sold until the end of the period, right? So here in October, right, we're going to just do this journal entry 1. We will not do journal entry 2 until we get to the end of the period. And when we are at the end of the period, how do we do this, right? Right, one of the things here is we got to look at the numbers again, right? We got our beginning inventory, they tell us, of 15, our ending inventory of 19, right? They do that at the end of October. That must be the end of the period, end of October, right? So we're in the beginning of October, at the end, there you go. So a couple things here, right? We have to first get off our beginning inventory, right? So we're going to do credit inventory beginning, right? They tell us that 15,000. Next, we got to get rid of all of these temporary accounts, right? So we debited purchases up here. We got a credit purchase down here to get rid of it. We got a credit freight in, right? Those temporary accounts for what? 21,560 and $500. And then, right, they tell us, right, when they did the physical count at the end of the period, right, our inventory, our ending was 1960, right? So then what we can do is plug or back into our cost of goods sold, right? So if you did like, the combo of these three, right, you got to get the journal entry to balance the debits and the credits. Hey, our cost of goods sold there is going to be $18,000. Another way you could think about this, right, is your beginning inventory was 15, right? Your purchases were essentially, right, equal to the 21,560 plus the 500, right? What we paid plus, the shipping, right? 2260, right? We add those together, right? That is our goods available for sale. In this case, our ending inventory was 19,060, right? So if we have 37,000 there, right, well then our cost of goods sold must be 18,000, right? Our goods available for sale were 37,060, of which, right, 19,060 we kept. That's our ending inventory. And then 18,000 we sold. That's our cost of goods sold. So I'm going to end the lecture here. We'll do a separate video. This one's a big guy problem here for that.